know me. I'm a real estate investor and fund operator. Over the years, I've worked with a wide range of investors who've built success in very different ways, business owners, professionals, and operators, many of whom eventually start to ask themselves the same question: is there a smarter way to deploy capital, especially retirement capital, outside of the stock market, like alternatives? So, in Deployed, I'm here not to pitch. I'm here to understand how successful people think about capital, risk, long term decisions, and to explore how tools like the self directed IRA may fit into their thinking. Today, I'm super excited. I'm joined by David Coe. He is a real estate sales and developer, as well as a real estate investor. He's part of FIBI, which is the largest real estate investment club in Southern California. I'm excited to learn a little bit more about that. He's also a speaker, a hiker, and a damn good cook. Hey, thanks for joining us today, David. Did I leave anything out? Did I miss anything?
No, that's pretty good. My day job is I'm a residential realtor here in the South Bay of Los Angeles, but
Okay.
all those other things you mentioned are also part of my world. I'm actually I'm an investor who became a realtor, not the other way around. A lot of
Oh,
people in
interesting.
that field, they get into sales and eventually get into investing. But my wife and I started fixing, flipping houses almost 20 years ago now,
Wow.
and I parlayed that into building a successful real estate company, helping people buy and sell residential, as well as helping to invest in real estate.
Oh, that's awesome. That's awesome. Now, what made you transition into being a realtor? Because that is rare. I don't think I've ever seen anyone do that.
Yeah, I mean, really, the reason I got into real estate was because I became a dad. At the time, both my wife and I worked in marketing and advertising. We had two young boys, they were 4 and 6, and I used to travel a lot, like 18 days a month. I was on the road,
Wow.
and they were starting to do cool stuff. They were playing soccer and they were, going to school and having like parents' nights out, and I was always gone. So
Yeah.
we were looking for a lifestyle change, and this is in the mid 2000s, and we had bought a couple of homes that we personally lived in, fixed them up, and did really well with them, and figured, hey, let's make that a career. So we bought our first property. We both quit our jobs, corporate jobs, and started working on this house. And along the way, I did get my real estate license, but at the time, it was just to buy and sell our own properties, not necessarily looking to represent other people. But we had a good run in 2006 and 2007, 2008 when the market changed. I realized that we knew a lot about how to fix up a home, but we didn't really understand anything about the economics of real estate and both macro and micro forces that drive it. So
Mm,
at that point in time, I started dabbling in other things. One of which was self-directed IRAs, which I know we're going to talk about today.
awesome.
And I also got connected with Phoebe, For Investors by Investors, which at the time I was just like everyone else looking for answers on what was happening in the world. And then over time, I've gotten involved both, from running an individual chapter as well as now I'm one of the partners that controls the brand of Phoebe, which is a California not-for-profit real estate investment club here in Southern California.
That's awesome, man. That's a great story. About Phoebe, do you guys have other chapters outside of California, or is it more just a local thing?
Well, technically we do. That we have a new chapter that's just starting up, that's more online, and it's really, I'll say, female focused. So it's not just for ladies, but they are for women that are investors that are organizing it. So they're going to kind of gear their content a little bit more towards women. Before the pandemic, we did have one in Chicago, we had one in Austin, we had one in Phoenix, but they didn't survive the pandemic. So, now I run a chapter in the South Bay of LA, which, if you don't know LA, everything south of LAX is considered the South Bay.
Okay.
But we've got a chapter in Long Beach. There's one in Orange County. There's one in Pasadena. There's one up in the San Fernando Valley. And Phoebe is our mission is all about education and networking, and absolutely zero sales pitches are allowed. So as a chapter leader, you can't sell anything. As a speaker, you can't sell anything. And because we have that no sales pitch environment, we tend to attract, I'll say, a higher quality investor people that want to come and learn and network and not feel like they're, walking into a sales pitch.
Absolutely, absolutely. Yeah, I would love to learn more about it. That's awesome. Thanks for sharing that. But before we talk about investing, I'd love to get a little bit more context about what the path of success looked like for you. Um, like, can you tell me about like, I guess earlier in your career when you started out on corporate and how you gradually transitioned into real estate?
Yeah, I mean, I was a marketing, well, really communications major in Cal State Fullerton. My specialty was in ad agencies and advertising. I did my first internship at an agency called Saatchi & Saatchi, which you may have heard of.
Hmm.
And then they had a smaller department called Team One, which handled the Lexus brand. So this was early in Lexus's development. I got exposed to a bunch of really smart people, both on the ad side and the client side. I'm a big fan of Toyota and how they run their company, and I kind of built my career through representing the more on the dealer side of the business, and mostly focusing on Japanese luxury automotive brands. So I worked for the majority of my career for both Lexus and for Infiniti.
Hmm.
And it was it's where I learned to be a professional. It's where I learned to be an adult. It's where I learned to collaborate. It's where I learned crisis management.
Oh.
I learned a lot of skills working for corporate America, with big budget, ad accounts like that, that I never really thought would translate into being self-employed, but it
Hmm.
really has. And I think helps me stand out against my, co-opetition, which in real estate, we're always competing and cooperating at the same time.
I like that. Yeah.
Yeah. But yeah, no, it was just also the point where the demands on my time and my family, and I wanted to do something on my own. And I always tell people I was getting tired of helping Infinity figure out how to sell, more high-end sedans, and wanted to spend more of my time figuring out how to grow my own net wealth and really create time where I could be a dad and still still be providing for my family at the same time.
That's awesome. That's awesome. Yeah. Time mattered more for you. I had a a similar road, whereas while I was working in corporate, I started doing digital marketing. So I really started to understand the power of marketing, and how that can really thrive in business. And it has helped me be successful in real estate as well. So I can imagine how you've applied it to your business as well. What do you think separates people who accumulate capital versus those who actually deploy it well?
Um, I learned this lesson a long time ago. I mean, of many, but being rich means you trade your time for money. Being wealthy means that your money makes money for you. And the path of acquiring assets and acquiring things that make money even while I'm sleeping versus when I'm having to physically spend time getting paid. Understanding the difference between those two was a big eye opener for me early in my investing career. I'll admit, man, when I was in corporate America, I didn't know anything about this. I had a 401k, we bought a home, we saved money, we had a stock account, but I was never taught anything about growing wealth or even money. I was a communications major, right? We didn't even take, those kinds of classes in college. So when we became self-employed, it really was a journey that we took on, kind of on our own. And honestly, I learned a lot of that through Phoebe and through the connections I made through Phoebe. It's why I'm still so involved in it because I've gotten so much out of it. And knowing what it means to gather assets and over time those assets help you build wealth. I think that's probably the best way to answer that question.
Yeah, I love it. I love it. I love it. How do you personally think about risk today versus earlier in entrepreneurship and what you were doing in real estate?
I mean, earlier on, we were starting from scratch. I mean, boy, talk about risky. We were definitely the kind of people that learned to jump out of the window and then figured out how to fly.
Yeah, yeah, yeah.
But at that time I was in my mid 30s, and my time horizon was a lot longer. So we definitely took on some riskier type of deals. Um, I would say over time, now 20 years later, I'm in my mid 50s. I have a little bit of a vision of what retirement looks like. Although you could kind of say I've been retired ever since I left corporate America. But I'm definitely looking at this point in time. I think probably a little bit more towards capital preservation versus capital growth. Now I'm still young enough to where we're looking at growing our net wealth. We're not purely in let's lock it down and preserve it mode yet. And I don't think it ever will be. I mean, I think a number one thing that an investor has to realize when okay, if someone says, I want to start investing in real estate, the first rule in investing is know thyself. You have to know who you are. You
Mm,
have to know what kind of risk tolerance you have. You have to know what kind of time commitment you're willing to make.
mhm,
Every deal is right for someone and wrong for someone
mhm,
else. And if you
mhm,
don't understand the lens in which you are evaluating a real estate investment opportunity, you can never truly evaluate it. Cash flow might be important, it might not be. Appreciation might be more what you're looking for. Some people are some people have personalities that can't even fathom the idea of giving their money to someone else and letting them take on all that control and responsibility. They need to have their control on the money at all points in time. Other people don't want any control. They just have capital. They want to know it's working and they don't want to have to think about it. So whenever I'm working with investors, I always spend a bunch of time in helping them identify what it is they're trying to accomplish. What kind of people are they? And then making sure they're looking at investment opportunities that are a good fit for them. And then you can start seeing whether or not the deal makes sense, whether or not the people you're investing with are good people, which is way more important, right? And who you invest with is way more important than what you invest in. It really starts with knowing who you are. And, I tend to be a little bit riskier. I mean, I am in development. We've done a bunch of ground up new construction projects here in Southern California. That's kind of, my latest investing that I've been involved with. But at the same time, as I get older, I can see myself being a little more conservative and looking more through preservation of capital versus growth of capital.
Ah, David, I loved what you shared. So from my perspective, in regard to you talking about know thyself as someone who may want to invest in real estate, I've raised a little over 8 million over the last 6 years, and I have started to realize, to your point, that the lenders that I borrow from aren't all created equal,
Mm,
and it has organically, I don't want to say forced me, but you learn through experience. I now take my time before I borrow from someone, because to your
mhm,
point, are they comfortable with giving me control over their funds, right?
mhm.
What type of opportunity are you looking for? Have you even ever lent on a deal before, right? Do you have experience in lending on a deal? Are you interested in something long term or something short term, right? What type of interest rate are you interested in? Where's the money coming from? What are your goals? So a lot of the lenders that I work with really appreciate that approach, because they can tell that I don't want to say that I don't need the money. I would love to have your money, right? So I can, do more things and put it to work. But I'm very selective on who I want to work with, right? Personality types and what it's like. And man, I've learned some lessons. And to your point, the ones who are just like, I don't want to think about it. I just want to know that my money is protected and that you're going to do right by it. Are the easier ones to work with versus the ones who you can tell her who have either been burnt before or they just don't have that personality where they need to be in control and always have updates and things like that. So yeah,
Yeah,
man.
and I'd also say, look, sometimes those people can be really good investors as well,
Hmm.
right? Because
Hmm.
they do force you maybe to look at something that you were missing, right?
Hmm.
Like it's okay to be pushed every now and then, but you also need to know, like, are they pushing you because they want you to be optimized versus are they pushing you because they don't trust you, right?
Exactly.
And
Exactly.
that's a difference. If someone doesn't trust you, right? Like man, that's a shitty environment for both you and for your investor to be in. and you're constantly at conflict, versus someone who's just kind of giving you a second set of eyes. I mean, I've done some capital raising where we're raising for other people's projects as well, and kind of feel like that's my job. Like if I'm raising capital to invest in someone else's project, and it's not just my capital, but other people's capital, it's kind of my job to be constantly poking around and
Hmm.
constantly understanding
Hmm.
what things are, and not because I want to be a menace, it's because I want to be a problem solver, right?
Hmm.
Maybe there are things that they are up against that I have experienced or I've experienced before, that I might be able to help provide some advice that's better for both, me and my capital, my investors' capital, and for them as well. And maybe I don't, right? And maybe it's a really, I mean, look, COVID created all kinds of situations that,
Yeah.
in some ways, we are still navigating it. And the impact of COVID has not left the
Yes.
investment community.
Yes.
Certainly on the debt side of things, we're still seeing the impact with high interest rates right now. Um, so, investing is a partnership, and you have to know who you're in partnership with. And again, who you invest with is way more important than what you invest in.
Well said. Well said. Um, what role does liquidity play for you right now? Is that important as far as like predictability?
I mean, not as much. I still run a real estate, brokerage business, so I'm still generating, income on a fairly regular basis. My wife is still employed. We're still getting W-2 income. For me right now, it's really about acquisition and, acquiring assets, right? Like I'm still in the asset acquiring phase. I have some, I still am an LP investor in multiple projects. I still am a partial GP on a few projects. And then, we have our own stuff that we also own, some smaller stuff here in Southern California. I'm still looking to acquire assets at this point in time. And, I don't necessarily need cash flow yet from my investments. So any that we do get, we tend to try to reinvest into other projects.
That's awesome. That's awesome. Are there any at this stage? Are there any kind of investments that don't interest you anymore?
Um, yeah, I mean, look, I'm a little sour on ground up new construction. It's really complicated, especially here in Southern California. Now, I'm not saying I would never do it again, but getting something out of the ground is really hard to do, and it's hard to do that when you've got investor capital involved in it. The really challenging part about that is, like, if you do a value add deal, let's just take an apartment building, and maybe it's under leased and it's got significant upside in rents, and you buy that project. It may not be generating the capital that you want it to, but at least it's kicking off some capital, right? It's kicking off some cash flow. Even if all that cash flow is just being reinvested back into the project, on a monthly basis, there's income coming in. For new construction, there is zero income until that project is done,
Wow.
right? And so all the time that you're going through that process, there's capital you have to identify up front or along the way, right? Having to raise additional capital, having to take on more liens, more equity, whatever it might be, along the way. And that part can be really challenging, when you're, the nature of development is, when you start the project, your debt load is this much, and when you get to the very end, it's this much, right? Because as
Yeah.
you draw down on your construction loans, every single day, the amount of money you pay in debt goes higher and higher and higher as you draw down those funds. So it becomes a challenging prospect over time, where you're having to, keep making capital payments, keep making debt payments. um, but at the same time, look, for the right project and for the right people, I wouldn't rule it out. But at this point in time, I do look, I think, maybe more on the value add side of things versus looking at ground up new construction.
Yeah. Gotcha. Makes sense. Yeah. Thanks for educating me. I was dibbling, dabbling, and starting to look at new construction. Ran across a couple of people said, Mike, you should do it. But I just don't know enough about it, right? I'm the type of person to want to learn or work with someone who's kicking butt in it before I execute. So it's kind of cool to hear your perspective of someone that's been in this. Thanks for sharing it. How do you decide if something is like worth your attention versus just noise?
Who the people are,
Mm,
right? Like who am I investing with, right? Most of over the years now, I've kind of made relationships with so many different people, both operators, investors, and I know who the people are that are kicking butt, right? That you mentioned. So I like to invest in people that I know, that I've done deals with before. To me, that's an easier path of entry. I don't necessarily have to do all the due diligence on them personally anymore because I've already got a working relationship with them. I like how they communicate. I like how they report. I like how they handle problems.
hmm hmm
You know this, Michael. There's no such thing as a deal without a problem. Every
hmm
single deal has a problem. It's not about finding a problem-free deal. It's about finding a deal where the person who's in charge of it is going to manage the problem successfully.
I love that.
And that's really where I think my focus is. If I'm giving my capital to someone else, I want to know that they're problem solvers and they do things efficiently and they let me know what's going on. Versus if we're buying something on our own, well, that's me, right? We know what we can do and we know who we are. But investing with someone else, I need to make sure that their number one focus is on the preservation of my capital and and transparency, and that they're going to let us know what's happening along the way.
Yeah, yeah, yeah. Well said. Well said. Um, I think that's why I've been successful because I always try to do those things, and it's always worked out well for me. Switching gears a little bit to the self-directed IRA. How did you first learn about it? How did that happen?
Yeah, it's interesting. We when I left corporate America, I had a 401k and just put it into an IRA. Had no idea, and then the crash happened in 2008, and we were looking for ways of raising capital. And I heard a speaker, and he was first time I'd ever heard the concept of self-directed IRA, and the way he described it was it's not that your 401k isn't allowed to invest in real estate. It's that your 401k administrator won't allow you to invest in it, but it's perfectly legal. And man, that hit me like a thunderbolt. I just became consumed with it. And the idea of investing in what right? I don't really know a lot about trading stocks and but I know about real estate. So you're basically allowed to invest almost in anything, as long as you don't have any personal gain from it, right? Like you can't invest in something you already own. It has to be purely for investment purposes. You can't invest in collectibles, right? So you can't buy artwork, you can't buy a fancy car or a wine collection, even though it might appreciate. Um, but can't buy life insurance. You can't buy. There's a couple of assets you can't buy, but pretty much anything that you can do with your own capital, you can do with your retirement money if you've got the money in the right kind of environment. And there's a lot of people that have money trapped. They want to become real estate investors, but they don't have any capital. But they might be sitting on a $500,000 IRA from from a previous company that they could absolutely convert into a type of account that will allow them to invest in real estate. And we when we raise capital because of that knowledge, I'd always say at least 20 to 30% of the money that we would raise would come from retirement accounts. And to this day, I still help people. It's not my primary focus. For a few years there, that was primarily what I did. But I still, will help advise people on what they can't do using their retirement accounts and just the metrics behind it and how it works.
Yeah, yeah, yeah. Yeah, listen, it's same thing with me, right? As I started to really get into real estate investing, to your point, I remember leaving one of my jobs and didn't even know that I think it was a 401(b) at the time. Didn't even know that it was sitting there for years. Once I got some letter in the mail and I called this custodian, it was like, yeah, it automatically rolled over to us. And I was like, well, what can I do with this? And they gave me the more traditional spill. And it wasn't until I started to get into real estate and start to understand the self-directed IRA that money was still sitting there. I immediately rolled it over and started investing with it. So it was pretty cool. I've now, like you, have been consulting people and helping them and explaining to them what they can do because, like you, right, I'm raising money all the time and looking to put that to work. So it's pretty cool. Where I've developed some great relationships with some custodians, and I learned that one custodian has some clients investing in exotic Russian racehorses. I was like blown away, which I thought was pretty cool. Uh,
Okay.
what surprised you the most once you kind of understood how it actually worked?
I mean, I think what surprised me the most was just that it was possible, right? Like we are so locked down by Wall Street and, they want all that capital. They've done a really good job of shielding, I think, the public from the idea that you can invest that capital outside of, publicly traded assets. Um, I mean, look, I think the idea of there's benefits in real estate that you don't get in investing in stocks or bonds or mutual funds, right? Like you can leverage, which you can leverage in IRA. Your IRA can borrow money, right? You can invest in funds that have debt, right? So you can create leverage on your capital. You can't necessarily do that with a stock portfolio. You can get cash flow, right? Which is something real estate provides that you don't, necessarily always get with a stock portfolio. There are some tax benefits. Now you lose some of that inside the IRA because you're already in a tax advantaged account. But to me, real estate is just a broader asset class, and it's one that I know better. And having control over that money and being able to invest it the way that I like, I think that was probably the thing that shocked me the most was just how locked down. I don't want to say conspiracy. I don't think that's what it is,
Yeah, yeah,
but it's definitely preservation. I look, even our current administration is looking to find ways to allow more investment into some private equities. Which I don't agree with a lot of things that they're talking about, but I think that's one that has been on the table through a few administrations. And I think it would be good for our industry in real estate to loosen the handcuffs on people and their capital. If you think about what's a great thing for retirement, right? It's owning real estate, right?
yeah.
It's having a long-term asset that can generate cash flow. So I think that's something that hopefully over time they will continue to improve the access towards.
Yeah. Oh man, listen, you actually answered my next question I was going to ask you. Like, why does retirement capital align so well with passive investments? But you hit the nail on the coffin. Um, do you do you have an opinion about lending versus being an operator? Does either or kind of make sense for you? Would you rather do one than another, or do they have their pros and cons? What are your thoughts there?
Yeah, I mean, look, when you say lending, right, there's lending where you're providing debt, versus there's lending where you're providing equity, right? Like I can be a limited partner in a deal where I'm making an investment. The pros and cons is generally on the capital stack. Lenders get paid before equity gets paid, right? So if I'm lending money to someone and the deal finalizes, I'm going to get paid first. Now, the downside is generally equity can make more than a loan, right? So if I'm investing on a deal and I might say, and a lot of deals have different levels you can invest in, right? Some of our deals that we invest in, we have, we consider priority equity, which is really just debt. But that might be capped at 10%, right? Versus the equity that has no cap. And maybe it's projected to have a 20% IRR back to investor. If you are looking for maybe less risk, debt might make more sense for you, right? You're secured, in most deals, but you're also limiting what your potential return is. But that's okay, right? If you only need 10% on your money, that's great. If you're someone who thinks, look, I'm going to be an investor in this deal, I'm still taking risk, and I would rather get rewarded from my risk, then maybe you're better being on the equity side. You won't get paid first, but if there's, if the the person you're investing with performs and the deal's anywhere close to what the pro forma stated, you might make more money on your investment. That's where it gets to knowing what you're, why are you investing? What do you need, right? If you need something more predictable, I think debt makes a lot more sense. If you're looking to maximize what your potential return is, equity may make more sense.
Yeah, yeah, well said, well said. And do you have a preference versus being a debt lender or equity lender versus maybe operating in your own deal? Do you prefer
I
one over the other?
Yeah, I mean, I don't. I have a little both, right? I mean, that's the other good thing about investing, this way. The advantage of maybe investing in some of these, let's call them syndications, or investing in other people's deals, is that you might be able to invest in smaller chunks of capital, right?
Yeah,
Like 25, 50, maybe $100,000, depends on the deal. Versus if I were to go buy, I live here in LA. If I want to buy a 5-unit apartment building, I might have to come out of pocket for $1 million, right, to get that deal done. Which is still a good deal if you've got that kind of capital. But if you don't have that kind of capital, that's the advantage of investing in this format, is you get to spread your money out over multiple different deals.
yeah,
So it's okay if you've got some money that is, involved as on the equity side versus some that's involved on the debt side. It also gives you the ability to create some diversification, right? Both in the asset classes you invest in, the people you invest in, the geographic location of the deals you invest in. I'm from New Orleans originally, which you might be able to see here on my
it's the same
behind
thing.
me.
Yeah, yeah. I just came from
And
a
yeah,
volleyball tournament.
what's that?
We just came from New Orleans. We had a volleyball tournament.
Fun place to go for an event.
Yeah,
I have family members that were heavily invested in New Orleans in rental properties, and then Katrina hit,
damn.
right? And man, their entire portfolio got wiped out. Now, they were able to eventually recover, but not everyone was, and they had a 2 to 3 to 4 year window where their portfolio wasn't performing, right? Versus being diversified out, around the country, around asset classes with different operators. That's one of the advantages that you have. You might lose control because you no longer are in control of the funds, but you get diversification, right? That's what the opposite end of that spectrum looks like.
Yeah,
So,
those kind of
I don't think there's anyone that should invest all their money in just one thing, right? I think you should be diversified, and you should spread your money out as much as you can.
yeah, yeah. Well said, well said. From your perspective, what does a good passive investment look like today? You would say.
Um, Good passive investment. I mean, look, I think, the biggest thing for all in passive investors right now is just the interest rates are so high. It's hard to find deals that have cash flow when rates are as high as they are. So, it's finding something where, first of all, you want to have runway. I think a lot of investors got, in the run up to, I think, where COVID was, where, this industry, there was a lot of people out there that were, looking to raise capital and invest, and deals got thinner and thinner and thinner. So what did they do? They started taking debt at lower and lower rates, but some of that debt maybe only had a 3 or 5 year time horizon on it, and then it reset. Well, 3 year money, if when it reset, you more than likely rates doubled in that point in time, and is creating a lot of stress and chaos right now in the
Hmm.
private equity space.
Hmm.
It's hard raising capital right now, because people that tend to invest in private equity are they tend to invest in multiple deals, right? Like, and most of those people that have money tied up in deals are preserving capital because they're still in deals that might need rescue capital, right?
Yeah,
And they don't want to deploy new capital until they kind of get a sense that we're kind of out on the other side of this particular phase. So I do think things are improving. Prices have moderated. I think, like all things, you have to buy right, but you have to buy right on a pro forma that gives you time, right?
Mhm.
Like it's one of the things that I've learned, and especially with new construction, the most important part of any investment is time, right? And the more time it takes, the more expensive it is. At the same time, the more time you have, the more time you have the ability to manage through certain issues and problems. So, you know, what does a really good passive investment look like right now? Something that has upside, something that I'm buying at the right price, right? Which is, well below where I think market value is. And something where my debt gives me time horizon to execute a business plan to improve my NOI. And I'm not up against it like with a very, very short time frame in which I have to execute that business plan.
Nah, well said, well said. What advice would you give someone sitting on a large retirement account who feels like stuck with like traditional options?
I always tell people to start shopping before you're ready to deploy capital,
Hmm.
right? Like I think, that's one of the advantages of running a real estate investment club. Um, you know, People want to come all the time. They're like, well, I'm not really ready to invest. And I'm like, that's the perfect time to come, right? Like, just come and start learning. I wish I would have learned more, right? Like, but when we started, we jumped out of the window and figured out how to fly, as we were crashing to the ground and, our tail feathers were on fire. Um, and look, we thought we did. Well, I mean, we did research. We didn't just do it out of thin air, but I wish I would have done more. So that's the first thing I'd say is get education, kind of understand what the world looks like, right? Like before you can start figuring out which lane you belong in, you're constantly going to be chasing the shiny object.
Yeah.
You kind of need to get a sense of what the playing field looks like, and then you got to figure out where do you naturally fit in that playing field, right? Maybe you are a passive investor, right? You don't have time to make daily decisions, but you want to know that your property is invested in something that is real estate related. So I think good advice to get started is understanding. Get some education first before you don't feel rushed to deploy the capital, right?
Mhm.
Feel rushed to learn and understand, and then spend some time really understanding what it is that you're looking to achieve. How old are you? When are you going to start drawing on those funds, right? Like understand that part of it, and then find deals that match your sensibility. I think every investment has an ownership experience to it.
Mm.
And if you're not comfortable with that ownership experience, no matter how well your money's doing, you're always going to be worried about it, which is not something you want to be. Real estate isn't liquid. Once you make that investment, you're in an illiquid situation. So you really need to be comfortable with the ownership experience of whatever that investment may look like. And if you don't know what that is, and you haven't learned enough to deploy that capital yet, you
Yeah.
know, talk to people, talk to previous investors whenever you're looking at deploying capital with someone. As many people as you can talk to that have invested with whatever that person is. I just think it's going to pay off in the long run because you'll have a better sense of what to expect. And then also, it's also understanding the risk versus the reward of that deal, right? Like, what you don't want to do is invest in a construction deal that's going to pay you a 10% return when you could go invest in a value add deal that might also pay you 10%. Or shoot, you could even lend money to someone who would pay you 10%. You have to make sure the risk that you're taking, you're being rewarded by with whatever the potential returns are in that pro forma. And it's hard to know what that landscape looks like unless you're starting to go out and look and talk to people and understand what deals look like.
Yeah. Yeah.
So
Well,
probably
well said.
that's
Get familiar with the space, right?
yeah.
Take a one-on-one course. No, that's great advice. Are there any conversations that you think investors should be having around retirement capital?
Um, I mean, look, I think part of that conversation beyond, let's say we're talking about investing that into real estate, it's also understanding what's about to happen to the stock market. There's a lot of people that think we're about to bubble, right?
Yeah.
We got this little AI potential bubble forming here. um, you know one of the lucky stories I like to tell people is when I first uncovered the idea of self-directed IRAs. I created my first self-directed IRA, and I moved my capital out of it right before the market crashed in 2008. Pure
Wow.
luck,
Yeah.
right? Like, and when everyone else lost 40% in their retirement account, I didn't, right? Just because I was in capital. Now, look, it wasn't like I didn't have distress also, but retirement accounts, the stock market can move very quickly, and we are still in a, there's economic cycles that still exist. So I think it's weighing both sides of it, right? Like, you have to understand, and have a good sense of, look, maybe you are ready to retire, and taking a 30% loss or hit in your retirement portfolio could be really detrimental to your long-term retirement goals. Maybe now is the time to pull some money off the table and looking at investing it into something that's a little more secure. I think this is it's a conversation that goes beyond just real estate. I think it has to do with your own financial plan, which if you don't have one of those, you should certainly work with someone that can help you develop that. Um, and just understand what the options are. I mean, I like how you said you have to know what the playing field is, right? Like, there's
Yeah.
a whole other playing field that you may have no exposure to,
Yeah.
and it's worth exploring that and figuring out if there's advantages of it. Everything's going to have risk, but again, if you can start to leverage some of your risk and mitigate some of your risk by taking some of your funds and putting it someplace else, it might be the right thing for you.
David, well said. Well said. Uh, that's all the time we have for today. Thank you again for those who are watching live. Thank you again to those who are watching the replay. If this conversation resonated, share it with someone who's built success and is now thinking more intentionally about how to deploy their capital. And if you're curious about self-directed IRAs, how they can be used for passive real estate backed lending, you'll find resources in the description below. Thanks again for listening to Deployed. David, thank you so much for joining me. This was awesome. I really appreciate it.
Thank you, Michael. Appreciate you